Hi, welcome to Eminent Stock Trading. This is Ravi Teja. In our last video, we learned about what is an option and how many types of options are there. Today, we will go in depth in options. As we discussed previously, there are two types of options. One is call option and another one is put option. In stock market, when stock price increases, then call option premium also increases. When stock prices decreases, call option premium also decrease. For put option, it is vice versa. When stock price increases, then put option premium will decrease. When stock price decreases, put option premium will increase. Frequently, we use some terminologies in options. Let's know about them. First one is spot price. Spot price is the current market price. Next is strike price. It is the set price where option contracts can buy or sell. Let's assume current market price of a stock is at 500 rupees, then it will be the spot price. Option contracts are available at different levels like 480, 490, 500, 510 or 520 and so on. These levels are known as strike prices. We can exercise option contract any of these strike prices. Hope you understand about spot price and strike price very well. Now we will move to option price. Option price is simply addition of intrinsic value and time value. Intrinsic value is difference between a spot price and strike price. It will never be in a negative value. Let's assume 500 is the spot price of a stock and 490 is your strike price. Then difference between 500 and 490 is 10 rupees is your intrinsic value. If your strike price is 510, then your intrinsic value will not be minus 10 because intrinsic value never be a negative value. Time value is value based on time bound, which is decreased when the time decreases. Time value becomes 0 on the time of expiry. Now we discussed about option prices also. Let's move to category of strike prices. We have three categories of strike prices. The strike price which is nearer to spot price are at the money options. For call options, strike prices which are below the spot price are known as in the money options, and the strike prices which are above the spot price are out of the money options. For put option, the strike prices which are above the spot price are known as in the money options, and strike prices which are below the spot price comes under out of the money options. For at the money and out of the money options, intrinsic value will be 0. It consists of only time value. For in the money options, it consists of both intrinsic and time value. Let's observe this graph to understand about intrinsic value and time value. For in the money options, intrinsic value is high and it is decreased gradually towards at the money options, and intrinsic value becomes 0 at the money options and remains 0 in out of the money options. For in the money options, time value is low and it increases gradually towards at the money options. Time value is high at the money option and gradually it decreases towards out of the money options. Now we learnt about at the money, in the money, out of the money options and the behavior of intrinsic value and time value in these three categories. Let's see example as an option buyer in three scenarios. Let's assume current market price of a stock is at 500 rupees. Person A buys in the money call option at 490 strike price by paying a 20 rupees premium consists of 10 rupee intrinsic value and 10 rupees of time value. Person B buys at the money option at 500 rupees strike price by paying a 15 rupees premium amount consists of 0 intrinsic value and 15 time value. Person C buys out of the money option at 510 rupees strike price by paying a 10 rupees premium amount, which consists of 0 intrinsic value and 10 rupees of time value. As expected, market moves 20 points upper side and closed at 520 at expiry day. Then the call premium of person A will be 30 rupees and person B will be 20 rupees and person C will be 10 rupees. Then person A get profit of 10 rupees and person B gets profit of 5 rupees and person C doesn't get any profit. Here we observed that market moves 20 points upside, but still person C doesn't get any type of profit because person C pays 10 rupees of premium amount at 510 rupees strike price. It means person C's break even will be 510 plus 10 rupees equal to 520 rupees. Person C gets profit only if market moves beyond 520 rupees. So in this scenario, we know that if market moves upside also, the probability of profit for person C is less as compared to person B and person A. Let's assume market moves up and down and closes at same price of 500 rupees. Then the call option premium of person A will be 10 rupees, B will be 0 and person C is 0. Then person A gets loss of 10 rupees and person B gets loss of 15 rupees and person C gets a loss of 10 rupees. Even though market doesn't move up and down, all ABC persons get losses because of time value becomes 0. Here in this scenario, person B gets more losses as compared to person A and person C. If market moves against our expectation and closes at 490 rupees, then call option premium of person A, person B and person C will be 0. Then person A gets loss of 20 rupees and person B gets a loss of 15 rupees and person C gets a loss of 10 rupees. In this scenario, person A gets more loss as compared to person B and person C. Now we have seen 3 scenarios of option buying and how important is the selection of strike prices to minimize your losses and maximize your profit. Today we have learned about option buying, and in our next video we should learn about option selling, where the traders makes money consistently. If you like this video, please like and share with your friends and subscribe to our channel for more videos. Until then, bye.